Hello, friends, clients, and colleagues. This is Rich Siegel, along with my two partners in crime today on the investment committee, William Lee and Carl Mariner. It's time for your September 15th, 2025 5 and 5 market update. We figured with the Fed meeting this week, it's an opportune time to review the markets and the economy and the rates markets in just 5 minutes. So take a second here to look at our disclaimer language for compliance. And I'm going to go first, and the 5 and 5 starts now. Okay, long-awaited Fed meeting. The announcement will come this Wednesday, roughly around 11 or 12 o'clock West Coast time. And you can see here from the Polymarket global betting site that there's a 90% chance of a 25 basis point rate cut, a much smaller probability of a more aggressive 50 basis point cut, and a very small probability of no cut. So I think it's baked in the cake that the Fed is going to re-up on their rate cutting cycle or easing cycle. And the good news here is that if you look historically on this chart on the left side, going back 35 years or so, there's been 6 other instances where the Fed went on an easing cycle. They took a pause to kind of gather the data, take the pulse, see how things are going, and then go ahead and start cutting again. And you can see that the last cut here was 12/18 of 24. So it's been 9 months. And the good news on the right side here is that once they start cutting, about a year later, markets tend to really love it. Bonds up 7.5%, and stock markets tend to be up double digits in the 20s. So if history is any guide, we have some things to look forward to, probably not in a straight line. It can be very choppy. The other thought here that we have is that perhaps this has been telegraphed for so long that the market's pulled forward some of those returns already. So that remains to be seen, but I would expect some volatility, some fireworks coming this Wednesday afternoon. So with that, I'm going to pass the torch to William Lee to discuss the rates and bond markets.
Thanks, Rich. In the top right, we have a chart of both. The green is the Barclays Ag bond index, and in the orange, we've got the Muni index. Both have provided solid returns this year, partly in anticipation of Fed easing and overall interest rates coming down throughout the year. In the bottom left, you can see the yield curve in the light blue, where it was a couple of years ago. All rates across all of the curve were above 5%. Today's a very different story. You can see the yield curve is a couple points lower at various points. One noticeable is the front end of the curve is still inverted. And the expectation with the Fed starting to ease again is that that will continue to normalize, which historically has been a good outlook for the economy.
It's pretty interesting to see just how inverted the front end was in the green and how it's still inverted. But it wouldn't take much to get uninverted and have a nice positively sloping curve if they were to cut rates by 1% and the rest of the curve stayed somewhere where it is today. Things would look quite normal. That's a good sign for the economy.
Very much so.
Yeah, good points. Okay, let's move on, and Carl Mariner will bring it home for the last 2 slides.
Perfect. And after some very good news from Rich and William, I thought I would take the wind out of everybody's sails a little bit. We'll talk about what's going on in the economy. Obviously, we talk about this a lot. The 2 major themes that the Federal Reserve is focusing on as they're considering cutting interest rates are the labor market and the inflationary environment. And so we grabbed a headline from last week about the labor market. So a pretty historic downward revision in the jobs market over the past 1 year of data. And so if we strip some of that away, it's just worth acknowledging a lot of the very positive news that we've seen about job gains over the past year, almost half of that seems to have been revised away. And so those were jobs that weren't actually being added. I think it adds an element of color to the theme that we've heard from people where they feel the recession or the economy isn't in great footing, but the data shows that it is. And so this kind of reconciles some of those things, that maybe the economy wasn't as healthy as we thought it was. Um, Moving on to the inflation chart, we're showing, the general trend over the last handful of years has been inflation coming down. But if you see that small orange chart in the bottom right, the data has been trending positive the last several months. And so we've seen inflation picking up a little bit over time. So all of this comes together to say that the picture isn't exactly crystal clear for the Fed as far as a rate cut is a certainty. A little bit of conflicting data. Obviously, the Fed would like to see interest rates or inflation, a little bit lower before they cut interest rates.
Yeah, what's really interesting is there's been so much recession talk over the years. It has not come to fruition. Even the latest Atlanta Fed GDP Now survey shows 2.5 or 3% GDP forecasted for Q3. It's amazing how some of this conflicting data is just not translating yet.
Reminds me of us saying, oh, sorry, Carl. It reminds me of saying that sometimes you got to worry yourself into success. And when everybody is worried about a recession, it's sometimes hard to get there because people take front run and they pull back on their business or some of the aggressive nature that they might have been pursuing.
Yeah, good point. Yeah,
that's fair.
Well said. Final slide, Carl. Take us home on the stock market, please.
Yeah, I appreciate those comments. I think they're a great segue into this. And I think, the best translation of all of that is simply that if you look at the data in the equity markets, some of the bullet points listed below, profit margins, earnings are at all-time highs still. And so it's difficult to see the economic uncertainty that we're talking about when the stock market continues to deliver really outsized returns. We saw 20+% returns over the last 2 years. Year to date, the S&P 500 is up about 12%. If you see from the bottom of the sell-off around Liberation Day forward, that's a 25%, 27% return over the last several months. So the market is doing very well. And it's more than just the S&P this year. If we looked at small cap stocks, they've done very well. If we looked at value stocks compared to growth stocks, they've done very well. International stocks have been a real return enhancer in addition to what we've seen from the S&P 500. So we're seeing positive returns. I think full circle to Rich's comment earlier, is that the market pulling forward the anticipation of rates getting cut, or is there more positive news to come ahead? Remains to be seen, but worth acknowledging we've had a good year so far.
Great. Let's end that on a high note, and we will see everyone soon. Thanks for your time. We hope you enjoyed our video.